Katha has mentioned, we are going to talk about fiscal consolidation. But I'll just start by giving you a brief, just a brief introduction as to who we are as ICEA Lion Asset Management. We are part of the ICEA Lion Group, which is a one-stop shop for financial and insurance and related financial services. And we have a very long and rich history and heritage dating back to the 19th century. And we pride ourselves in terms of being innovative and an award-winning fund manager. And broadly, the sectors of the economy that we participate in are in insurance, pensions, investments, and trust. And this has continued to this day. We are a member of the First Chartered Securities Group, which is a leading regional investment and trading group with major business interests in banking, insurance, logistics, manufacturing, and agriculture. So as I said, we have a strong heritage, and we believe in excellence in service delivery, qualitative and innovative products and service designs. We also assure our clients of the very highest levels of integrity and professional service. So with that brief introduction, it's now my pleasure to introduce our Head of Research, Mr. Jad Murigi, to take us through the rest of the presentation. Welcome, Jad.
So I'll start with revenue growth. And what our analysis shows is that government revenue has averaged double-digit growth over the last 5 years, despite slowing down sharply in 2018. And the revenue mix has remained largely unchanged, with income tax contributing 40% of government revenue, followed by VAT, value-added tax, which contributed around 25% of government revenue, followed by excise duty and import duty. Looking at the tax revenue to GDP ratio, it has remained fairly stable over the last 5 years, starting 2014 at 19% and remaining fairly constant until 2018 when it fell to 17% of GDP. What we note here is the tax revenue to GDP ratio for Kenya is still above the 15% minimum threshold that's required for accelerated growth and development according to the IMF. And looking at Kenya's tax to GDP ratio as a percentage of government of GDP relative to other countries, we note that Kenya is above Uganda and Egypt, but is still lagging the likes of Mauritius, Senegal, Morocco, and South Africa. So what do we need to do to improve the ratio of tax revenue to GDP? There are 3 things based on experience with other countries. First and foremost, ensure that the war on corruption is won. Secondly, broaden the tax base by simplifying the tax system, and then eliminate unnecessary exemptions. These are the steps that Kenya needs to take to improve their tax to GDP ratio above 20%. Moving to recurrent expenditure, we note that over the last 5 years, interest on debt has grown the fastest, with interest on domestic debt increasing by doubling to 240 billion in 2018, and interest expense on external debt increasing almost 8-fold to 84 billion in 2018. However, the larger costs still remain wages, employee costs, wages and salaries, which rose from 270 billion in 2013 to almost 400 billion in 2018. There's also this category which is other expenses, other operating expenses, which rose from 306 billion in 2013 to 445 billion in 2018, an increase of 50%. We see opportunities for fiscal consolidation, especially in this expenditure line. It needs to be analyzed further. At the moment, the expenses tend to be lumped together and described as other operating expenses. And we think that if sufficient additional detail was provided on this other expenses category, opportunities for fiscal consolidation could be identified. Looking as a percentage of revenue, interest expense has increased from 14% of revenue in 2013 to 24% of revenue in 2018. And notably, this is a step in the right direction. We see that employee costs and other OPEX as a percentage of government revenue have declined from 71% in 2013 to 67% in 2018. So this is a step in the right direction in terms of fiscal consolidation. Moving on to development expenditure, we note that the biggest categories have been transport, which refers to the rail network largely, infrastructure, which refers to the road network, and the planning and statistics department have dominated development expenditure since 2015-2016. The other thing we note about development expenditure is that in 2018, it was at its lowest level since 2013. So in 2018, when development expenditure of 470 billion was spent, that was the lowest level since 2013. And development expenditure peaked at approximately 600 billion in 2017, before declining to a 5-year low in 2018. Here we look at what has really driven the increase in government debt. It has been a very topical issue. Government debt has basically doubled since 2013, from around 2.5 trillion shillings to around 5 trillion shillings. So that's an increase of approximately 2.7 trillion shillings in the 5 years. And what has driven that increase in debt? It's essentially the government has collected revenues of approximately 6.2 trillion shillings over the last 5 years, but the government has also incurred expenditure of around 9 trillion shillings. So that's what has created that increase in debt. Now, looking at this government expenditure of 9 trillion shillings, when you analyze it, we see that recurrent expenditure has contributed the lion's share of that government expenditure. Approximately 70% has gone to recurrent expenditure. That includes county allocations as well, whereas development expenditure has contributed the remaining 30%. So the key takeaway here is the increase in government debt has been driven largely by recurrent expenditure as opposed to development expenditure. So how does a public debt mix look now? Well, in 2013, external debt and domestic debt were roughly 50-50 of government debt. But in 2018, we see that external debt has risen to almost 60% of government debt. So the government debt mix has shifted more in favor of external debt. Coming to the debt to GDP ratio, it's risen from around 44% in 2013-14 to 52% in 2017-18. And just benchmarking Kenya's debt to GDP ratio against other countries, we observe that Kenya is almost at the mid-range in terms of public debt to GDP compared to other countries. We then had a look at the cost of debt, and what we observed is the cost of external debt is 3 to 4 times cheaper than the cost of domestic debt. So the cost of domestic debt over the last 5 years has averaged approximately 13%, with the cost of external debt averaging around 3%. So domestic debt is approximately 4 times more expensive than external debt, the cost of external debt over the last 5 years. However, we note that the cost of external debt rose from 2% in 2013 to 4% in 2018. This is because the external debt is becoming more commercial and less concessional. So you can see the cost of external debt is creeping up. And in terms of the mix of treasuries, we note that in 2013-14, treasury bills accounted for approximately 1/4 of domestic debt. But as of 2018, treasury bills accounted for more than 1/3 of domestic debt. So even as the government lengthens its maturity profile, we're seeing a bigger concentration of domestic debt in treasury bills. Turning over to bilateral debt, our analysis shows that debt to China has increased almost 8-fold between 2013 and 2018, from 63 billion in 2013 to around 480 billion shillings in 2018. As a result, China's share of bilateral debt has almost tripled from 24% in 2013 to 66% in 2018. Overall, however, the external debt mix has remained fairly constant in terms of bilateral debt, remaining constant at 31% of external debt. And the reason for that is because commercial debt has also grown between 2013 and 2018. In 2013, commercial debt, which is the syndicated loans and the Eurobonds, was only less than 10% of external debt, but now it's almost 1/3 of external debt. We then had a look at best practice fiscal consolidation as observed in other countries, especially in Europe. So these are countries that you can see the column change in debt, the likes of Belgium, Denmark, Ireland, Italy. They managed to reduce their debt to GDP ratios by anything from 15% to 50% to 70%. So we examined what did these countries do to reduce their debt to GDP ratios, to pick up some best practice tips. And we picked up 3 ways to grow out of debt, or rather to reduce a debt to GDP ratio. The first thing is expenditure-based consolidation tends to be more effective than revenue-based consolidation when it comes to reducing public debt. So instead of the government focusing too much on revenue mobilization, it should put equal or even more effort on expenditure-based consolidation, which has been proven to be more effective, especially when it comes to employee costs. The second lesson we learned is that expenditure-based consolidation must be decisive and lasting rather than timid and short-lived. So you have to take almost drastic steps to manage expenditures. It cannot be short, intermittent steps. And the third way to reduce the debt to GDP ratio is to stimulate economic growth. So what some of these countries did is they grew their way out of debt by stimulating economic growth. And in that regard, we would recommend a reversal or modification of the rate cap, which seems to be the key constraint to economic growth currently. So in summary, to summarize what we've spoken about, we said that revenue growth has been double-digit until 2018 when it slowed sharply. Kenya's tax to GDP ratio has declined slightly, but it still exceeds IMF's minimum threshold for accelerated growth and development. And this tax to GDP ratio for Kenya can be improved by winning the war on corruption, broadening the tax base, and limiting unnecessary exemptions. On the expenditure side, we note that there has been some progress in terms of targeting key expense lines, namely wages and salaries, which have reduced as a percentage of revenue in the last 5 years. And in that regard, we also think the current initiative to restrict or reduce government allowances, civil servant allowances, is a step in the right direction. The other thing on expenditure is additional disclosure or detail on recurrent expenditure may identify new consolidation opportunities, especially the line item called other expenses, which is 20 to 30% of recurrent expenditure, which was around 400 billion in 2018. So breaking down that number, analyzing that number to greater detail could identify additional consolidation opportunities. Regarding the debt situation, the increase in debt over the last 5 years has been driven more by recurrent expenditure and county allocations as opposed to development expenditure. We also know that external debt is now a higher proportion of government debt than domestic debt. And then finally, again, key messages: winning the war on corruption, pursuing expenditure-based consolidation, and accelerating economic growth are key to debt sustainability and managing Kenya's debt situation. And I think that brings us to the end of our presentation. I think to your first question, I would say that yes, it appears that current expenditure consolidation efforts have focused on development expenditure, and that is not growth-friendly consolidation. Growth-friendly consolidation needs to focus on recurrent expenditure while maintaining development expenditure, because development expenditure is eventually what leads to economic growth. Regarding your second question, Yes, our analysis shows that the growth in debt has been driven mainly by recurrent expenditure, because the bulk of government expenditure over the last 5 years has been recurrent expenditure rather than development expenditure. We've seen some efforts, as I mentioned. We've seen the wages and salaries, ratio of wages and salaries to GDP, to revenue, decrease from over 70% to around 67%. So there is some positive steps, and there's also the recent move to reduce civil servants' allowances. So we've seen some steps in the right direction. But like we said, again, expenditure-based consolidation needs to be decisive, and also we need to see a better analysis of other operating expenses, because there seems to be a good opportunity to, good consolidation opportunities in other operating expenses, which form 20 to 30% of recurrent expenditure and need to be analyzed in more detail to see where there could be opportunities to cut costs. As regards the cost of external debt, yes, it factors in FX, because what we did is we used the cash costs of external debt from the budget policy statements, which implies that it's already been converted into local currency.
What I can say is that if you've seen, our revenue yield has actually fallen to about 17%, and that is not good, because while our GDP has actually appeared to perform, at least our headline GDP has appeared to perform well. What I always say is that you don't necessarily pay your debt with GDP. Just like somebody will tell you that I'm generating revenue of 100 million, but I'm making losses in terms of profits. You can't pay your loan if you are making losses. So the bottom line is that you pay your loans with taxes. So that is also an aspect that we need to be conscious about, that our tax yields have not been performing as well, at least in the last 2 years. And that should be, in my view, a matter of concern as well, as much as we also want to undertake expenditure consolidation. But we need also to focus in terms of improving our taxation and seeing where there are tax leakages, because obviously with GDP growing so well, I mean 5.7 is not too bad, while the tax appears to be not nosediving but actually declining. That should be a source of concern to us, because that is where we pay our loans, not the GDP that we grow with. It is good, it is a good indication, but it is not enough, and that actually comes in terms of debt sustainability as well. So we have to look at both what we are producing as taxes and debt as a function of GDP as well.
I think also just to add on to that, we've also seen from a recurrent expenditure perspective, civil service, which is obviously one of the biggest components of the expenditure, recurrent expenditure for government. And I'm sure you've seen there's been quite a lot of work going on in terms of rationalizing allowances in terms of the civil service, because those are one of the, I mean, the fact that there is a lot of there are a lot of these allowances that are not well structured, and I mean there are very many, and there's an effort to try and harmonize that. Of course, there's been some resistance to that, but I think there's an acknowledgement that there's an effort that's going into that. Secondly, there's also been when you look at some of the issues that also need to be addressed. For the last several years, the government has talked about the development of a funded retirement fund for the civil service. And that will address a significant portion of the expenses of government, because right now, the pension payments for retired civil servants are funded from the budget, from the recurrent expenditure. And once you have a funded contributory scheme, then that will also address a significant portion of government expenditure. So what you're also saying, these are also measures that have already been announced by government and structures already set in place. So what you're saying is that, in our view, these are areas that need to be expedited so that we are able to manage those costs. because for as long as it is not funded, it's an avenue that we have no sight of in terms of what extent it can grow to. So I think it's an area that, in our view, is important for government to address.
The fact that a huge part of Kenya's economy is informal is a challenge to revenue collection and to the tax revenue to GDP ratio. So that's a challenge. So there's need to broaden the tax base, like we said. It seems like a significant part of the economy is not subject to tax because of the informal nature of a huge chunk of the economy. You know that informal employees